Welcome to Crunch Times, the place to be to make the tangible connections between your business operation and its financial performance. Today, we are going to talk about how to read any financial statements, including your own business. Knowing your numbers and learning how to interpret and analyze them is one of the crucial skills you have to have in your business. And today we are here to uncover a lot together. So let's get to it.
What exactly are financial statements? These magical documents provide a window into a company's financial health and performance. Financial statements and reading those numbers might sound intimidating at first, but that's why we are here. And we are here to make these statements relatable and easy to understand. So let's break them down. The first one that we want to talk about is the income statement. Income statement shows us a company's revenue and expenses over a period of time. It tells how well a company performed in making money. So now let's look at an example of an income statement. After every statement, I have an example so then you completely understand what we are talking about. Here is an example of Long for Success, a sample company, and they are in event planning industry. When you look at the statement, we ran it from January to August, so a specific period of time in 2023. And as you can see, it shows their income and broken down between different revenue stream. You can basically play around with the display and how you want to categorize your revenue. Also shows your cost directly related to your revenue generating activity, which is your cost of goods sold. And also at the bottom, it shows your operating expenses, which are mostly your fixed costs. It's not related directly to revenue. Regardless of turning $1 million or maybe 500,000, you still have those revenues. And at the bottom, you can see the profit and loss. The next statement that we want to talk about is the balance sheet. So it tells us what the company owns, right? Their assets, and what is their liability or their debt, as well as what is the shareholders' stake in the business. This statement is a little bit different from the income statement in terms of the period that it shows. So balance sheet is specifically at a specific point in time. What do I mean by that? So we ran the income statement from, for example, January to December or each quarter. But when you run a balance sheet at the end of March, for example, it's gonna look very different than running it at April 1st. For example, looking at the cash balances in the bank, so you might pay salaries, right, at the last day of the month, and then your cash balance might decrease dramatically from one day to the other. So the same company's balance sheet, I ran it for December 31st, 2022. And as you can see, it starts from showing assets broken down between current and non-current. Non-current means that we are not going to be able to turn them into an asset for less than a year. So for example, if you have a building, it's not a very liquid asset, so we put that into non-current asset. It also shows your liability and also the owner's equity. And as the name indicates, it always needs to balance, right? The next statement that we are going to look at is cash flow. As the name stands, cash flow shows the flow of the money in the business. So where the money comes from and where we spend the money and how we use it. Let's look at the balance sheet for Line for Success, shall we? So if when you look at their cash flow, you can see that how much they have generated or used cash in their operation, if they have invested, and if they have paid down their debt in terms of financing. So cash flow statement is broken down in three separate buckets. One is operating, the next one is investing, and the last is financing. So the display always starts with the operating section. When you look at the flow of cash in a business, specifically if you're investing in that business and it's not your own. It's really illuminating. It tells a lot of stories. So it means where the cash is spent, if the company is really heavy in their debt and paying down the debt, or they're really actively raising funds, or they're really focused on growing their operation. So you might ask, why do financial statements matter? It matters because it helps us make informed decisions, specifically about investing or lending money or even running your own business. If you have your own business, you know how important it is to know your numbers. And having that knowledge on reading your financial statements and being able to analyze and read between the lines and understand the story behind those statements and numbers is what really matters. It's also like putting a puzzle together to see the bigger financial picture of that specific business you're looking at or your own. Up to now, I showed you what financial statements are and we looked at what each of them show you. But we need to also decipher and understand the story behind each of them. Are you ready for that? Let's go. So one of those tools that is available to us is trend analysis. Trend analysis means you really run those statements on an extended period of time and start looking at the trend. For example, for this line for success, when we looked at the profit and loss statement in the previous slides, we only looked at the total income or total expenses, like all those lines on a total basis. But here I ran it from January to June, so for a period of time, but I ran it on a monthly basis. And what I'm curious to see here is why my revenue from January to March declined from 11,000 to 9,000, and what is happening in month of May that I'm like looking at 14,700 revenue. So just quickly looking at this business, not knowing that they are in the event planning space, I assume that there are so many seasonalities within this business. So for example, February, maybe everybody's coming back from the vacation and New Year and there is no event happening. And in May is when everybody's trying to get all those events in before the summer holidays come around the corner. So that's how kind of you look at the trend if you are analyzing a business that is not your own. And if you own this business, you also want to understand why, when I had my revenue in January, I produced $7,000 in profit. And then when my revenue grew to 14 in May, I was able to only generate 5,000. So this shows that a lot of expenses within this business are variable expenses, right? Those cost of goods are really high. And then I go one step further and understand how can I control my cost of goods to be able to maintain the same level of profitability within my business. So only by doing a quick trend analysis and not going really deep, only looking at income, cost of goods, expenses, and profit, you are able to really see and read between the lines and understand the details about the business itself and try to question yourself, really understand, talk to your team, and then come up with smart plans of making your business more prosperous. Another analysis that is really beneficial is cost and profit analysis. And how we do that? When I run an income statement again for the same period, January to June, I'm curious to see what is the gross profit percentage. So when I did the quick math, dividing the 4,000 here by the total income, I got to 9.33%, which is super low for a gross margin percentage. And what does that tell me? It tells me that this business, or if it's my own business, doesn't really matter. It means that I'm generating $4,000 in gross profit to be able to sustain my fixed cost, hoping that I will make money. So when you look at the fixed cost that is listed here, you come across the rent expense line, which is 8,700. So then you understand that your gross profit is not enough to pay your rent, let alone other expenses that is in the business. And as a result, you see that this business is not making a profit, and in the contrary, is producing $9,400 in losses. So this is another analysis that you can do to understand how healthy your gross profit or your gross margin is, and what is the level of your cost that you need to cover after generating those gross profits. The next analysis that I'm going to show you very quick is doing your ratio analysis. And this is done mostly and a lot of times on your balance sheet. So through ratio analysis, I want to understand what's the ratio, for example, between liabilities and asset of a company. Is this business asset rich enough to pay the liabilities and also still have some cushion? So that's the ratio analysis that I'm looking for. Another ratio analysis that I always look at when I'm looking at the balance sheet is I'm looking at the accounts receivable numbers to see how much of my asset is really tied into accounts receivable compared to cash. So if a business has only, for example, $5,000 in cash and maybe $50,000 in accounts receivable, which means the money that other people owe you, that's a red flag. So that's, as a business owner, I really need to contact my customers, let them pay me back, or understand what is the problem that they are not paying me. Are they like legitimate businesses that I need to continue working with, or I really need to revise my practices? So these are all the ratio analysis that you can definitely perform when you're looking at your balance sheet. There are so many other ratio analysis out there, but my promise to you was to make this video less overwhelming, so I'm not going to bear you with all those ratio analysis here. I want you to really think outside the box and ask yourself, are these analyses enough? Looking at your trend analysis, understanding your profitability and cost, and then really studying the trends. Because there are some financial analysis pitfalls that we really need to be aware of, including overlooking the context, really relying on one metric, and then the last one that I wanted to list here is ignoring non-financial factors. So let's dive into these. Am I increasing my revenue because I'm just selling to everybody and I'm not considering if they are worthy customers enough to pay me back? So then I just sold and increased revenue, but I'm not sure if I'm actually gonna get my money back. So then try to understand different metrics, and sticking to one sometimes can be really risky and dangerous. Also, ignoring non-financial factors. So if your business is thriving, should you also look at, for example, if your business is so successful in the past couple of months, do you also need to look at the impact of interest rates? How is the economy is doing in general, and what are the impacts that the future of the economy in short term is going to have on your business? So do you need to have more cash in the bank? Do you need to sell some of your assets? Do you need to buy more? Do you need to revise your pricing strategies because of all these increased costs? So understanding a lot of non-financial factors that are in the market outside of your business is also super important to really get a handle of your financials. I'm so excited to share with you that we are building a toolkit and it's coming to you very soon. We have already finished building our pricing strategy and also break-even calculators, and so much more is coming. So make sure to subscribe, check out our blog post, look at our toolkit, and really take advantage of all these free tools that we are putting out there for you to make your financial and business life easier. Until later, best of luck to you.